So welcome to our corporate finance revision class. So we're going to look at assorted topics, but basically my interest was unit 1 and 2. I will gather up other units just to do the revision. This is specifically revision, so I would expect you to participate. The introductory part is simply the introduction to corporate finance. I'll talk about a few issues here and there and how the questions come surrounding them. So basically, when we're defining corporate finance, we're looking at the financial manager and the type of decisions that he makes. So basically, there are 4 key decisions that actually spell out the whole syllabus of this course. So managers will engage in 4 key decisions, starting with what we call investment decisions. So with these decisions, managers will actually apply themselves in determining which portfolios to invest in. They will undertake what we call a decision-making process, which has about 5 steps. Now, these investment decisions should be for the benefit of the owners of the business, who are the shareholders. So managers will stand in on behalf of the shareholders to make the right decision that will be optimal both for the company as well as for the owners. So these investment decisions now will take us to what is called capital budgeting. So this is where calculating the NPV, IRR, and selecting the best project for the company comes in. So this is where the decisions come in. So you should be able to understand when to accept a project as being viable, when to reject, and how to calculate the investment appraisal methods like IRR, AAR, and profitability index. The other decision that the manager must also have are financing decisions. Now we know that company has 3 main options in which they would source their finance. They would finance themselves using what are called retained earnings. Now these ones are the safest and the cheapest ways in which companies would want to finance themselves. The retained earnings here imply plowing back the profit. So instead of having a cost, you would rather want to use the profits plowed back. Another source will be borrowings, which we call debt capital. Now, this debt capital may either be from the primary or secondary market. So this now takes us to another mini question to say, you need to define the capital and the money markets. What are these markets? And examples of securities that are involved there. So anyone, what are money markets and what are capital markets? So when you're dealing with capital markets, basically we're looking at financial markets where we trade with long-term debt and equity securities. Now, these markets, you must understand, are crucial in the allocation of financial resources, and they will enable businesses, government, and individuals to raise funds. So capital markets basically will consist of the primary markets where new securities are issued. And we also have secondary markets where we trade already existing securities. So in the money markets, can somebody tell me what are money markets and what are capital markets quickly, and what examples are there in each of them? What are money markets and what are capital markets? I said money markets are financial markets where we deal with short-term borrowings. Capital markets are markets where we deal with long-term borrowings. So if we're dealing with examples of money markets, we're dealing with stocks, we're dealing with bonds, we're dealing with derivatives. So financial instruments whose value is derived from the value of underlying markets like the options, the futures, swaps, etc. So in the capital markets, these are long-term securities. Examples, we have stocks, bonds, and derivatives. In the money markets, these are securities that have maturities of a year and below. And examples, we are dealing with treasury bills, certificates of deposits, commercial papers. And these securities really play a very vital role in the financial system. Okay, any questions so far? Are we together? So we also go to the dividend decisions. When you're dealing with dividend decisions, they basically involve us determining a policy that is appropriate for a firm. This policy should describe how the returns from the investment should be distributed to the shareholders, how the returns should be distributed to the owners of the business shareholders. So you need to choose what dividend policy is appropriate for a particular company. Now, these questions that are surround this kind of element, we need you to have a critical analysis. So I'll take you to the exam question and how it came surrounding what I've just asked. But before I proceed, are there any questions on what has been explained in Unit 1? Any questions? Okay. So you need to have deeper understanding more than just considering what I've just talked about. If there are no questions, we'll proceed to a question that came in the paper. So, let's look at the question that came from. We'll look at question number 5. Question number 5, the exam paper. Okay. So question 5, we're talking about Airbus is a leading aircraft company or manufacturer owned by a European aeronautic defense and space company, a global leader in aerospace defense and related services. Having its headquarters in France, it has fully owned subsidiaries in the United States, China, Japan, Middle East. It has its spare parts in Hamburg and Frankfurt, Washington, Beijing, Singapore, training centers in Miami, Hamburg, Beijing. This company has about 150 field service offices around the world and employs a total workforce of 119,000, and its presence is on every continent. So with that background, question number 1, what additional risks exist for a company like Airbus when over trading overseas? And give reasons why a company will be willing to face risks of over trading overseas, and explain at least 5 actions that a multinational company can take to limit the effects of possible restrictions on the repatriation of profits. Okay, so here we're looking at a case study. Can anyone talk about the risks that could be associated with the company trading in different countries? What type of risk could be incurred? So we have several kinds of risks. There are about 10 types of risks that we can talk about, but I only consider 6. So a company like Airbus, which operates globally, may face several risks when it comes to trading overseas. Anyone mention any risks that you think this kind of a company may face? So we're looking at investment decisions also in terms of trading overseas. So the risks that this company may basically face could be political risks, exchange rate risks. We have something to do with the law, regulatory compliance risks, cultural and ethnic or risks, supply chain risks, security risks, among others. So I've mentioned political risk. Can anyone come in how Airbus may experience political risks? So these questions, he would want you to analyze them from an analytical perspective, please. Of course, we have different political environments from country to country. So a company like Airbus is more likely to be exposed to inevitably political risks, such as changes in government. Elections happen every other year, 5 years, depending on which country. So each government that will come in will have their own policies, trade restrictions, sanctions, political instability, geopolitical tensions. Okay, like we are almost currently having with Zimbabwe. So these factors could adversely affect their supply chain. Another kind of risk, inevitably, in the economic cycle is the currency fluctuation or the currency risk, currency exchange risk. So this is a risk that exists when there's instability in foreign currency. So this can impact the cost of production adversely, where pricing of commodities and overall profitability. Another example would be ShopRite. You see how different prices will apply for different countries because of the exchange rates. So Airbus, being a multinational company, will have to deal with this kind of risk, which is associated with the currency devaluation or appreciation of different countries. Comes in favor if company is in a country where the currency is performing well, and others it will be more expensive. So others would want to, for instance, buy DSTV with a card from USA because it may be cheaper. This is owing the fact that you may have this current exchange risk. What other risks did I talk about? What other risks did I talk about?
Legal, supply chain.
Talked about supply chain risk now. The supply chain risk is a risk that comes about because of global operations. This risk is susceptible to disruptions that may come in, such as natural disasters, political unrest, changes in trade policies. Such disruptions will affect the supply chain. It will affect the timeliness of delivery of aircraft components, leading to production delays. So this is a supply chain risk that may occur. We have cultural and ethnic risks that may also be incurred because of different cultural environments, like the Arabian, they have their own cultural sensitivities. So Airbus will need to be sensitive to different cultures and must do a feasibility study, especially in countries with different customs and values. Some values are reputational. So already we are having a challenge in Zambia regarding the opening of a strip club. So these are to do with cultural issues. The other risks that I talked about would be security risks. So aerospace industry is a target of cybersecurity and may pose threats. So as you're answering questions like this, you need to actualize the kind of business you're talking about. So when you're talking about aerospace, it has cybersecurity and industrial risks. So companies like an Airbus may face such risks of database breaches, intellectual property, sabotage, and these may compromise their technological edge and competitive advantage. I also spoke of the regulatory and compliance risks. These ones have to do with various regulations. So each country has different regulatory frameworks. So non-compliance to certain of them would actually bring in legal issues. I was just talking to an individual yesterday discussing Congo and Zambia and how trade between these two countries has continued despite there being no law in Congo. So Zambia has in most cases compromised on the sanctions put on the Congolese. So being head of security says certain times when we impound their cars or we arrest the Congolese, we discover that they will retaliate in a very bad way, even if we have a Zambian with all the papers there, just because we've arrested the Congolese, they will look for any Zambian who is in their country and they want to pay back. So these are things that happen in the risks that we have. Is that clear? So I need you to ensure that you fortify. These are 10 marks in your own best manner. These figures are just statistics. There's no calculation in this question. Are we together? So we looked at these questions a day before those guys wrote, and most of those who were in my class really, I think they remembered. Okay. So, any questions? So we can now go to part B. I hope that was clear. So part B, we're being asked to give reasons why a company will be willing to face the risks of trading overseas. Why would you engage in trading overseas? Why would you undertake despite the risk? So there are several reasons for trading overseas. One being market expansion, diversification of risk, economies of scale, competitive advantage, comparative advantage, and also resource access. So inevitably, companies need to grow. So accessing new markets can lead to increased sales growth opportunities, and also in regions where there's high demand for a particular commodity, companies would want to grow. Diversification is also another issue. Companies would want to diversify. By diversifying, you spread the risk associated with economic, political, and regulatory changes. You reduce their impact by spreading them in different countries. Economies of scale. Trading overseas will also enable companies to benefit from the economies of scale. So including the lower production costs, access to cheap labor. In Malawi, there's a lot of cheap labor, and also cost-effective sourcing of materials. Sometimes bringing materials into a country may be costly. Setting up a plant in that particular country will be cheaper. Competitive advantage also. So establishing the presence of foreign markets can also provide what we call competitive advantage over the rivals who are solely focused on domestic markets. So this will come from an early market, an entry level, brand recognition. And once they know that this company is an international company, it gives competitive advantage. Resource access. So trading in other countries, foreign countries, will give you access to raw materials, like I mentioned, specialized technology that may be readily available in those particular countries. So it is important that you consider all these. 5 marks for that. Explain at least 5 actions that multinational companies can take to limit the effects of the possible restrictions and repatriation of profits. What 5 actions can a multinational company take to limit effects of possible restrictions on the repatriation of profits? Anyone? So there are several actions that can be taken. Number 1, we have what we call hedging. Hedging. So hedging strategies, usually multinational companies can use such financial instruments, such as what we call forward contracts, options, swaps, to hedge against currency fluctuations. So this is actually a setup that comes in to ask people to pay ahead of time, regardless of the fluctuations in the currency, that you still pay for the good at present. So this will reduce the risk that is associated in repatriating profits in different countries. The other way in which we can limit possible fluctuations will be local investment. Local investment. So when we're talking about local investment, we're basically looking at investing in local infrastructure such as research, development, production facilities, So these ones will give you, will reduce the regulatory barriers that may come in from different countries. Then we also have tax planning. So implementing a tax planning strategy, such as transferring what we call transfer pricing. We also have what is called tax treaties, offshore operations. These ones will help minimize the tax burden. The other ways in which we could limit repatriation on profits is political engagement. So here, having a dialogue with countries like Congo, multinational countries, we need to have an understanding where we are going to lift taxes on certain products to engage in trade. Then diversification of investments is another way. So diversifying investments across different countries can also reduce on the dependence on the single market. So this is a theoretical question that will need some analysis. So just coming from unit 1. So 20 marks is how you're supposed to get them from a question like this, streaming from just unit 1. Are there any questions so far? We're together. I will not discuss much. Okay, the questions that would come on types of businesses, bring in a scenario question. You're asked to advise him on what kind of business he must undertake. I think some dividend policy. Okay. This is yeah, financing decisions, yes. So the first part, like I said, most of students want to underrate these questions because they read them on surface level. Part A business that is expanding is considering using debt to fund planned projects. They plan to arrange the financing first, then consider the expansionary projects once they know what money is available. Comment on the adopted strategy in view of your understanding of financing decisions and investment decisions that a modern manager is faced with in a contemporary business. I think I mentioned this. Can somebody answer this question from what has been discussed? A business that is expanding is considering using debt to fund planned projects. So they plan to arrange the financing first. Then after they plan to arrange the financing, they will consider expanding projects once they know what money is available. Comment on this adopted strategy in view of your understanding on financing decisions and investment decisions that a modern manager is faced in a contemporary business. This is revision. I need your input. Janice? Esther? We're still on unit 1, by the way. I'm waiting. Anyone?
Okay. Maybe just to chip in
Mhm,
on the financial decisions.
mhm,
In the introduction, you had mentioned something about the retained earnings that
mhm.
have to be considered when making such decisions. So in this case, okay, I'm just not sure how to answer it, but maybe in this case, the company, the business would have to look at how much is currently available, how much they have earned, and if it's really viable that the earnings that they have will be able to finance their decision, their business. I don't know, something like that.
Okay. At least you've tried. So you see, these questions are not as easy as you think. It's just on unit 1. You need to be practical. So many people lose marks because they talk amiss. You don't use guesswork, you use the concepts. Okay, so I've answered most of these questions. Let me begin by saying this, that long-term projects are critical for company growth. Investment decisions are also pivotal in determining the allocation of resources. Now, financial managers are usually continuously thriving to seeing where we allocate the resources to make what optimal investment decisions, which include capital budgeting. It's the most fundamental tool where feasibility, profitability of projects are actually assessed. So here, a conservative approach should be adopted by the financial manager to ensure that there's a thorough evaluation of the risks and returns before we commit these funds in the long-term projects. So there's need to utilize the available capital will align to achieving these sustainable and objective profitable growth strategies. So we need to be strategic when we're investing in these. So the financing decisions that we need to look at, number 1, under financing decisions, the manager must consider striking a balance between debt and equity. Because debt has a cost, equity has no cost at all. Remember, under equity, there are also retained earnings, as Janice has mentioned. So you need to prioritize the company's objective. What is their key objective? What is the capital structure like? The decisions of whether to raise capital from the market or from the owners, you need to consider issues like costs, the risks, the availability of funds. So a balanced mix of equity and loan capital will help to minimize the costs. Are we together? So adequate financing will allow the company to undertake strategic initiatives. Here, initiatives such as megas and acquisitions in the expansions. So a sound financial decision must critically be analyzed and looked at by the company's manager in enhancing the company's financial stability. So here there should be effective financing strategies, and these strategies must be taken critically into account to seize growth opportunities, of course, withstanding the market fluctuations. So there's need to align the financial decisions with the company's growth and objectives. That's number 1. And also to ensure that there's available resources, not only for the short term, but for the long-term projects. So an optimal financing mix is inevitable. It's needed. So strategic financing decisions here will be put in place to synchronize the investments and debts that are pivotal in creating a robust financial framework for this company. So the impact that may have on the company in terms of ordinary shares and corporate bonds. So to start with, before I continue, I'm trying to give